Hi, everyone. Thank you for joining me again for another episode of the Optimized Wealth podcast. My name is Lance Norquest, investment advisor with Bellwether Wealth. And today we're focusing on the giving season and ways to incorporate smart philanthropy into your financial wealth plan. If you joined us for last week's episode, you'll know that we touched base on a few of these topics, again pertaining to tax efficient ways as we approach year end. But again, this episode, we're going to focus on that philanthropy giving. How can we use those gifts this time of year to be tax efficient? Obviously, we see a lot of the red kettles and the volunteer bell ringers throughout the nation ringing and trying to gather charitable gifts from various individuals. And those are great ways to give to charities. But for those more sizable gifts, let's talk about ways that we can be more tax efficient. Obviously, one easy way to give would be to provide cash to a charitable organization. It's very simple, very straightforward. Most are happy to help facilitate those types of transactions. If you itemize from a tax standpoint, you're able to offset a portion of your AGI or adjusted gross income by doing so. But instead of giving cash, maybe a more tax efficient way of giving would be looking at your investment portfolio. Especially some of us that have been invested in maybe some of those large tech names or AI stocks or those highly appreciated assets over the last several years. Chances are, if you're still holding them, you probably have some sizable unrealized capital gains. One way to be tax efficient is instead of giving cash or writing a check to a charitable organization, you should gift highly appreciated stock or investments. Again, you can do that and still accomplish that dollar amount or that value amount that you're looking to do for this year. But instead of just doing it with cash, you're able to gift that stock and all of the appreciation that came with it. That way, down the road, you don't have to realize that capital gain and then pay taxes on it. So again, think about it this way as an example. If you were to give cash to a charitable organization, and let's say it needed to come out of your brokerage account, and we sold some investments, so you're going to realize the capital gains from the sale of those transactions, and then you write the check from your brokerage account to that charitable organization. Again, you're accomplishing all those things that you want to accomplish, and the cash that you write is going to be used, or you can use that value of the cash to offset your adjusted gross income, but you now just realized taxable gains. So again, by giving the stock or the highly appreciated asset directly to the charitable organization, instead of doing the transactions and realizing those gains, you're being tax efficient. Another option for being tax efficient, and this is going to be for more of the retirees, is going to be through your retirement accounts or those qualified accounts where you have a required minimum distribution. Again, this is only going to impact those that are 73 or older. But let's say you have required minimum distributions or RMDs currently coming out of your retirement accounts. Instead of you taking that required minimum distribution in that mandated amount pre-calculated by the IRS, and then you paying ordinary income taxes on it, and then later on in the year, writing a check to fulfill your charitable giving strategy or your charitable giving goal, what you could do instead is just do it directly from the IRA via a qualified charitable distribution. Again, by doing that, you are avoiding the ordinary income that you're going to pay on every dollar that comes out of your IRA in the form of an RMD, and instead you're doing that qualified charitable distribution or QCD directly to the charity. So you are fulfilling a few things. You're fulfilling the fact that you're charitable giving. You're also going to fulfill your RMD, or the amount at which you give is going to be deducted from the amount of your RMD on that year. And third, you're doing it very tax efficiently because that by doing a QCD or qualified charitable distribution, you don't have to worry about the ordinary income taxes of the withdrawal or distribution from the IRA for that year. Something else we talked about in last week's episode, and again, getting into it a little bit more, are donor advised fund accounts, or DAFs, DAF. What's good about using these types of accounts is you can contribute to them now. Think of it like a charitable checking account. You're giving or contributing to the account today, and you're getting the charitable deduction today or in this tax year, but you don't necessarily have to do the gifting to those charitable organizations in that same year. So as an example, let's say you went through a liquidity event. You sold your business, or let's say you had a very high income year, got a raise at work, or maybe even the fact that you received a large cash performance bonus through work. Again, you're in a high tax year. What are some ways that you could lower your taxable liability, if you will, for the year, but also fulfill some charitable giving? Again, a donor advised fund account is one of those tools that we can leverage. Again, you give to it today, and that gift doesn't necessarily have to be cash. You can also use highly appreciated assets. So going back to the original topic, stock or ETFs or exchange traded funds or mutual funds, you can give assets to these donor advised fund accounts. You're going to get the deduction today. And then again, whether it's next year, the year after, or maybe 5 or 10 years down the road, you can be thoughtful and not rushed in your giving or gifting decisions. It allows you to kind of be able to, take action in that high tax year and be efficient as possible, but then not feel rushed to make sure you're pushing out your gifts in that same year as well. Something else we talked about last week's episode as well on donor advised fund accounts is bunching. Bunching essentially is a strategy to take multiple years of regular giving and put it into 1 year, so that way you hit the you can itemize and use that to offset your taxable income on the year instead of taking that as standard deduction. And then again, what that allows you to do is bunch multiple years into 1 year, get the deduction this year, and then it's still in that charitable fund, donor advised fund account, which will then allow you to, again, be thoughtful and push those deduction or those contributions or those gifts out to those charitable organizations, as you go year over year, or in whatever strategy or schedule that you choose. That's it for today's episode. Again, thank you for watching. My name is Lance Norquest with Bellwether Wealth, and we'll see you next time on the Optimized Wealth Podcast.